a critical U.S. decision getting global attention.
At today's meeting, the committee raised the target range for the federal funds rate by a quarter percentage point, bringing the target range to 4.75% to 5%.
The Federal Reserve Bank has decided to raise interest rates by another 0.25%, despite the recent turbulence in the banking sector caused by the emergency takeovers of Silicon Valley Bank, Signature Bank, and Credit Suisse. This has caused concern among many depositors, who have been withdrawing their money from regional banks and moving it to larger banks. There has been much debate over whether the government will continue to rescue depositors if a bank goes under. Jerome Powell, the chairman of the Federal Reserve Bank, has made some interesting statements about inflation and the future of the economy. He stated that they expect inflation to end in 2023 at 3.3%, which is higher than their previous estimate of 3.1%. This indicates that the Federal Reserve Bank believes that inflation will stay around longer than originally expected. Powell has also said that interest rates will have to go higher and they will have to be more aggressive with interest rate hikes to cool inflation down. The Federal Reserve Bank is an independent entity, separate from the government, and it has the ability to print money, lend money to the government, and set interest rates. Powell recently met with Congress and warned that interest rates would have to be raised because inflation wasn't coming down fast enough. This caused panic in the banking sector, and many smaller regional banks are still uncertain about their future. In the most recent meeting of the Federal Reserve Bank, Powell raised interest rates by only 0.25%, despite the earlier warning that they would have to be more aggressive. This is a significant change in tone from the Federal Reserve Bank, which previously stated that they would do whatever it takes to bring inflation down to 2%, even if it caused pain in the economy and layoffs. Powell now acknowledges that they have to bring inflation down, but they don't want to break the banking sector or the economy. This shift in tone is the first of its kind, and it signals that the Federal Reserve Bank is taking a more cautious approach to dealing with inflation. The recent turbulence in the banking sector has shown that even the larger banks are not immune to the effects of inflation and interest rate hikes. Powell's statements about inflation and interest rates will have significant implications for the future of the economy and the banking sector. Investors and depositors will need to pay close attention to the actions of the Federal Reserve Bank in the coming months to see how they respond to the changing economic landscape. In conclusion, the decision by the Federal Reserve Bank to raise interest rates can have a significant impact on the economy, both domestically and internationally. While the Fed may raise rates in response to inflation concerns, it can also lead to higher borrowing costs, which can dampen economic growth. It is important for investors and consumers to pay attention to the Fed's policy decisions and adjust their financial plans accordingly. Additionally, policymakers should consider the potential impacts on various sectors of the economy when making interest rate decisions. Ultimately, the goal of the Fed is to maintain a stable and sustainable economic environment, and its interest rate decisions play a crucial role in achieving that goal.